still trickle in. So, all right, I'm going to go ahead and get the program started again. There'll be a few people joining us. That'll be through the back door as we move along. But Mahmoud assured me that's okay with him. So I'm going to introduce Mahmoud El-Gamal. He's a professor of economics and statistics and chair of Islamic economics and finance here at Rice University, and he's also a Baker Scholar. So Mahmoud, the floor is yours.
Thanks, Ken. So I'll try to keep this short and sweet, because you've all had lunch, and I should have finished 5 minutes ago. But this is joint work with Amy. She will talk more about geopolitics, I think, in the next panel. But this is the stuff we agree on. The rest I may or may not agree with. And I have a very simple story to tell. So the first thing to do is to compare apples to apples and recognize that if you look at the acceleration and deceleration of global GDP, so what is plotted here in blue, well, I guess even that doesn't show. Wow. Yeah, it sort of does. Okay, so I wrote my own, it still doesn't work. So the blue curve is the rate of growth of world GDP. So when it goes up, it's accelerating. When it goes down, it's decelerating. And that is what correlates reasonably well with world energy use as the growth rate of world energy use. You'll see a number of graphs that I always try to, this is just one of the first things you do. You try to make all your series sort of nice and mean reverting so you can be comparing them. Otherwise, trends can cover up the structure that you're looking for. So if we look in terms of acceleration, deceleration of GDP and energy use, we see this very clear secular business cycle. And then the question is, well, where are we right now? And where we are is that we're in a decelerating phase. Here I'm just going to, I know Edgard was very optimistic, I don't know why. I'm just going to use the forecast for global GDP growth from the IMF's World Economic Outlook, which I think is sort of the gold standard for this. So the expectation is that we're going to be having modest sluggish growth. One forecast after the next is coming out. China is slowing down, India is slowing down, Brazil is slowing down. Where is the world going to get significant growth in order to have a big recovery and then increased energy use? We don't see it. So I'll take this as a given that we are in a decelerating global economic environment, and therefore, other things equal, we don't expect that energy growth is going to be significant. Demand will grow significantly. And I'll have a few more slides to try to elaborate on this point. So one of the reasons that we expect energy growth to be weaker yet is that we have a secular trend that GDP is becoming less and less energy intensive. So this is a combination of improved efficiency and of the service sector in the GDPs of most countries growing faster than the manufacturing sector, which is more energy intensive. So you combine sluggish GDP growth with secular reduction of the energy intensity of that GDP that is growing at a slow pace, and we expect that the demand for energy will be anemic at best. I must say from the very beginning, the title of the talk, title of the paper is the relationship between supply and demand and our view about price prospects in the medium term. So everything is going to be looking forward about 3 to 5 years. We're not looking in the very short term. We're not looking in the long term. 3 to 5 years will be our sweet spot, and I'll explain why. So that's why I'm looking only at growth rates in the next few years. Okay, I don't particularly like this graph, but Amy thought it would be very useful to see where the sources of demand are coming from. But the other thing we can see here also is demand destruction in the mid-1980s. And Ken has already sort of discuss the idea of the demand destruction that happened then, and do we expect something similar now? And do we then expect also a similar collapse of oil prices as shale oil comes online, much like North Sea oil came online in the early 80s, while there was demand destruction then, as we expect to have demand destruction now. We know, of course, that most of the growth, and Ken showed a graph also which showed China and India being the areas where most demand for energy was taking place, but we recognize also that these are the countries where the energy intensity is declining the fastest and where growth has been slowing down precipitously. And I think it was either last year or the year before, we had a whole study on China in which my paper suggested that Chinese growth was going to slow down within a year or two to about 7%, and that once it breaks around 6.5%, we think there's going to be serious geopolitical trouble in China, and things can really go into a tailspin. So China is definitely going to get old before it gets rich, and I wouldn't bet too much on Chinese energy growth continuing linearly. That would, I think, be unwise. So, okay, price. I'm going to show you a bunch of graphs. So, the rule of, I'm a teacher, so the rule of teaching is you tell them what you're going to tell them, then you tell them, and you tell them that you told them. And here what I'm going to do is first tell you what I'm going to tell you. This is not the best graph to see it, but it's the most common graph. Here we have oil prices, real oil prices, in the sense that you're fixing the year 2005 at 100, and gold prices where 2005 is 100, so they can fit on the same scale, because otherwise, obviously, gold is in the thousands and dollars are in the tens or hundreds. But they're essentially almost nominal prices. They're just an index by the 2005 prices. The thing to notice, which I would show you, then I told you that I showed you, is that the relationship is quite different back in the 1973 to 79 episodes and what happened now. And it will be much clearer in a different graph that I'll show in a little while. But basically, the story in the 70s was really a story of inflation. And you see it in all commodities. Gold here is sort of the default measure of inflation. And oil just simply catching up and overshooting a little bit. And the events that made oil shoot up were a story for why we expect oil prices to go up forever. So it's very similar to what we heard this morning about, after 2003, you have a couple of geopolitical events and people say, oh no, oil prices are going to go up forever. And that sort of feeds the financial machine, because the trend is the trader's friend. They start buying it because it's going up because of the geopolitical story, and then people see it going up, so they buy it because it's going up. It goes up because they're buying, right? And the same machine was already in evidence before. I wish we had this graph going back, but I'll show you something similar here. This is very different from what happened in the 2003 period. You have a period of the great moderation when both prices are sort of going sideways. And then 2003, well, first 98, of course, oil prices go up, but the gold doesn't respond to that. It's 2003 when oil prices start going up, and oil leads gold in that period. So back in the 70s, early 80s, gold was leading. Here, oil is leading. The reason I mention this is when I show you the coherence diagram and explain to you how to read it, the story is different, and you cannot capture it with correlation. Correlation sort of averages out over too many things, and it doesn't allow you to consider a phase shift, where the cycles may not be completely synchronized. So, gold goes up from 1971, basically, when Richard Nixon closes the gold window, until 73. And then there's a story about the Arab-Israeli war that allows oil prices to catch up with all the other commodities. Then it sort of stagnates for a while. And while the US is still inflating away the international financial system. And then 79, you have another story about the Iranian Revolution. And so oil prices catch up. Okay, you can see that better when, so there are a number of graphs here. The blue one is basically a combination of those two graphs. So what I'm going to do is denominate oil in gold. And in order to fit it on the same scale as world GDP growth, I'm going to look at how many 50ths of an ounce of gold it costs to buy 1 barrel of oil. Okay, so if I go before 1970, of course, it was pretty fixed because both prices were fixed at the dollar. But what we're seeing here in the blue curve is how until 73, actually, oil was getting cheaper. That is, gold was going up and oil was constant. And then the story in 73 is the Arab-Israeli war. So oil tries to recover, but then it overshoots. Its long-term average. So again, I told you I'm going to try to make everything mean reverting. So I'm comparing apples to apples. So I don't have trends masking what's really happening. So this horizontal blue line is the long-term average for this sample from 1970 until 2013 of how many 50ths of an ounce of gold, and this line is about 3.3. So it takes, on average, 3.3 50ths of an ounce of gold to get a barrel of oil, and the process is mean reverting. You know, it goes up every time there's a geopolitical story, it overshoots to catch up with gold. Then you have again mean reversion. It overshoots in the opposite direction. Then there's a story in 79, so it overshoots again. Then it comes back, and on it goes. Okay, so this is the real price of oil, if you will, denominated in gold. Using the CPI is very, very deceptive because the basket of commodities used in the CPI is not a particularly good measure of inflation for anything. Plus, a lot of the inflation that we have now is inflation in asset prices. It is inflation in house prices, it's inflation in commodity prices, it's inflation in stock market prices. This is one measure that I'll use, which is a nice one because it's mean reverting of the real price of oil. So if there was a target to what I think on average it should be, it's around here. And then I superimpose that with the graph we had before, which is the rate of growth of world GDP. The pattern, which has been studied econometrically very extensively by people like Jim Hamilton, Lotskilian, and many others, is that high oil prices lead to recessions, and then low oil prices lead to recoveries. So the high oil prices of the 70s drove us into recession, and then oil prices became very low relative to gold, and then we had a recovery. And if you just go on see every peak of oil price, you'll find it's followed by a recession, and every bottom of oil prices is followed by a recovery. So the sluggishness of the global economy that we're observing now is in part because after the crash, so we have actually not just deceleration, but negative. So this is zero growth here. So we have, of course, the Great Recession in 2008, 2009. Oil prices never really crash enough to get a recovery. They crash immediately, and we start to get a recovery. And then the Fed, my story is the exact opposite of what Edgard said. The Fed is inflating away asset prices, preventing them from coming back to the normal levels that they should have given the current level of economic activity. So what has happened is that this recovery was stymied, and we don't have data beyond this point. Oops, where am I? We don't have later data, but basically the recovery was stymied quickly because oil prices were held back, and they're hovering around their mean. Their mean is good enough if growth is at its mean. It's not going to cut it when we need a strong recovery. Okay? So part of the story is oil prices are too high for us to have a recovery. Because we don't have the recovery yet, demand destruction is going to continue, and other things equal, we expect prices to collapse. Okay, so I told you before I was going to tell you about phase shifts. So what is shown here, the reason correlation is bad is it doesn't distinguish co-movements at different frequencies. Now, Daniel did, showed you correlations at different frequencies. Let me show you the monthly. Let me show you the daily. But what you could do is show them simultaneously. And then you can, if you use, and in the workshops, I went into a lot more of the technical detail, but Ken told me to spare you that. But basically, if you use a method that was developed in signal processing back in the late 1980s, early 1990s, in order to break a series into all its possible frequencies, we can analyze co-movements at different frequencies at different points in time. There's a Heisenberg uncertainty principle. We can't exactly calculate it all these points because you have a finite number of data points and you have an infinite dimensional thing, but you can statistically. And everywhere where we observe co-movements at a particular frequency, at a particular point in time that is significant, and this is significance relative to sort of a standard run-of-the-mill stationary time series ARMA model, it will be yellowish or reddish, and the arrows are going to tell you which series is leading which. So all the areas here where you see red or some yellow, we are seeing co-movements at a particular frequency at that particular point in time. And then the way the arrows work is if they're pointing to the right, it means that these are perfectly synchronized. So of course, before 1971, before closing the gold window, they were perfectly synchronized because they were both fixed, right? And you can see in the very long run, so this is now, so this is obviously the date, and then this is the period in years. So at the bottom here, I started at around 3-month frequency. And in the earlier workshops, I showed it all the way down to the weekly and even semi-weekly. But for the purposes of looking to 3 to 5 years, it's enough to do it here starting in the monthly. So what you can see is that back in 1973, there was actually a lot of co-movement, correlation, if you will, at the high frequency. So this is of the order of 2 to 3 months co-movement reaction of oil prices to gold prices. And now, if the arrows are pointing to the right, I told you they're completely synchronized. If the arrows are pointing up, that means oil is leading. If the arrows are pointing down, that means gold is leading. And if the arrows are pointing to the left, it means they are in cycle, but they are at a pi over 2 phase shift, which means when one is they're in anti-phase. When one is going up, the other is going down. Okay? So you can see that there's a lot of action way back in the 70s. There's nothing really completely novel about the 2004 onwards. Indeed, if we're starting the analysis from about 3 months, you can see that there was more gold led, because it's pointing down a little bit, in phase. So gold went up first, and then oil joined it, and it happened twice. By 79, it was at a slower frequency, so this is more like 8 to 10 months. And now it's starting to be anti-phase and oil-led. So from 79, the story, it really becomes more, the inflation is sort of a baseline now, and the Iranian revolution is really a bigger deal. And then you get, of course, the Iraq-Iran war and so on. You can see 1990, it's very brief, because the first Gulf War was just a quick blip, and Saudi Arabia responded very strongly. But you can see also some in-phase movement at very, very high frequencies. The more important thing is more recently now, because we're going into the future, is we have that period after 2003. So there's some action there, but it's not very significant. The real action happens, of course, around 2008. And that is happening simultaneously at 2 different frequencies. So in the shorter frequency, that's about 4 to 6 months, we are having a lot of oil-led movement. Okay, so this is the Matt Simmons era, right? This is the peak oil. People are buying into the story. The Iraq war, so oil starts moving. All these hedge fund managers are looking for anything that moves. They're borrowing up to their ears in order to buy it. Then it starts moving, and so everybody else is buying it because it's moving and it feeds onto itself. So that's the higher frequency stuff. Lower frequency at the annual level, they sort of go back in sync, right? And then if you go to very low frequencies, so 2 years behind, they're back in sync. So that's basically the range we're interested in. What's going to happen in the 3 to 5 year range, right? And they seem to be almost perfectly synchronized, sort of more oil-led in the shorter term, more gold-led in the longer term. Okay. All right, so this is the demand story. We have sluggish demand, and other things equal would mean that prices are not going to go up much. And we're in a period when we're done with the high inflation, sort of gold-led world, so that's not going to keep prices up. So ultimately, our punchline is the only thing that can keep prices up will have to be a geopolitical story, which I think was sort of, in a way, also the punchline that Ken gave. But that was the demand side, okay? Business cycle is in a sluggish recovery, if you want to call it that. And we're in a world where there are no other reasons for oil prices really to be high. Supply, we're going to look at it. And so the Hubbert curve, which Ken also mentioned, is sort of, if you follow, there are lots and lots of wells that they're discovering and they're coming online. And so you'll have a smooth increase, and then eventually you run out of oil and it starts going down. But there can be breaks. And so we want to look at responses in supply that are either voluntary or involuntary, in the sense that you either invest in technology in order to recover oil that wasn't recoverable before, and therefore you jump onto a higher Hubbert curve, which is what we're doing now, and which was what we did with North Oil in the early 80s, or that you're destroying production because you're not investing, you're over extracting, and therefore you jump onto a lower one. And of course, you can continue on. So we're going to use a similar wavelet technology to the one I showed you before for looking at the different frequency relationships between price of gold and price of oil. But this is just for illustration. You can look at so this is monthly production of US oil, which sort of peaks around 1970, as Herbert had expected. And then, as Ken pointed out, it sort of responds a little bit to price incentives. But in general, it's a nice smooth curve. And the technology we're going to use in order to check for a break actually does detect a break around 2011, but that's just too close to the end of the sample really to trust it. So we don't know. And Ken also showed that upswing from 2011, but it's too soon. I mean, you might argue it started in 2009, but it's too soon really to check this one. But the technology basically is to take this production series and then break it down into the different frequency wavelets. So you can have lots of high frequency movements. So this is the lowest level detail, which is in the 2 to 4 month frequency. Then you go up to 4 to 8 and so on. And then the highest level of detail here, we're going to that 3 to 5 year sweet spot that we're looking for, which is 32 to 64 months. And then there's a smooth, of course. So this is the upswing that Ken was showing you earlier from 2009, which again I think is too early to really just use that statistically. Although we know shale is coming on, and that's a different structural argument. So what we're going to do is take the smooth plus level 5, so all kinds of fluctuations up to 3 to 5 year, and abstract from everything that's higher frequency. And that's what we're going to check if there's a break in it. So it finds a break around here in this series. It doesn't find any breaks before that. A more interesting example to illustrate it is Venezuela, where you had this big strike in 2003. So production basically plummeted for 1 month, and then it recovered very quickly. And you can see that's a good test case. This shouldn't affect the 3 to 5 year Hubbert curve that they're on. And in fact, you can see that most of that action was absorbed in the lower level frequencies. So when we add the smooth and the level 5 detail, it shows like just a simple smooth movement, not a break. The break actually discovers in Venezuela is back here in 1973 when its production surged, which of course, if you look at it here, is a huge jump, right? So this jump stays because for 3 to 5 years, output stays higher. This jump goes away. Okay, so that's how we can abstract from things that are weather-related, transient, geopolitical or financial events, etc., and look only at these kinds of productions. So So of course, we know what happened after 79. 73, 79, prices are high in the 70s. So there's a lot of investment in new technology. So you can now build offshore platforms that can withstand wind and waves and all that stuff. And you can dig deeper than before. And so output surges. And so if we look at output in the UK, we find as early as 1978, according to this wavelet analysis, a big jump upwards. So that's jumping onto a higher Hubbert curve for the UK. Similarly, you find for Mexico a jump around 1981 onto a higher Hubbert curve. And here for Mexico, we have the, so whenever we have the, so what we're showing here is the blue line is the actual monthly production. The red is the smooth plus fifth level detail. So anything up to 3 to 5 year effect is included. And then, if available, the chocolate-colored curve shows the number of rigs in operation in that country at any given point in time. So you can see in Mexico, right, that the investment starts in the late 70s, and around 1981, our testing methodology finds a break to an upward Hubbert curve at that point. More technology-driven, so ignore sort of things that are too close to the boundaries. But in the case of Brazil, you get the 1998 price effect, and we find an upward break here. So this is completely data-driven. The data is finding all the breaks up to breaks that affect production in a 3 to 5 year span. So you find the break to a higher Hubbert curve around 98. Again, so this is the Lola effect, if you will, in 2005. And then again in 2009. So jumping up, up, up onto higher Hubbert curves, 3 of them. And of course, that is the secret of the Brazil miracle, because you have all these oil rents with which to invest. Similar effects in Angola. We find a break around 2005. I'm not an expert, but probably the same technologies are being deployed in different places. OK, so this is, so one effect we expect of high prices is continued investment in better technologies to recover more oil you couldn't recover before. So we have the sluggish demand. High prices are causing that sluggish demand, preventing a recovery, right? And at the same time, these higher prices, as Ken said, they work in the opposite direction for supply. It is boosting supply. So we have stagnant demand, surging supply, other things equal, we expect prices to fall. The only things to stop this is if other countries are going to curb back their supply. So some countries will curb back their supply for economic reasons. So here, so you have the, so Herbert had this simple, geologically based curve-fitting story, and it sort of excludes all economic considerations. We've already seen, even with the U.S., that when prices were low, production declined. When prices rose, production recovered. And of course, the canonical case of this is Saudi Arabia, which for the longest time has been the swing producer. So what economic variables am I going to consider? Well, we have here 5 variables. We look at gold prices, because that's the measure of overall inflation. We look at the WTI price itself. So basically, when you monetize this, how much do you get for it? Then we look at the S&P 500, which is a measure of what would you get if you took these proceeds and invested them in the stock market. We look at 10-year Treasury yields, which is a measure of if you took it and invested it in a riskless asset, which so far has been riskless, the Treasury notes. What yield would you collect? And then we look at the PMI as sort of a measure of current economic activity. And then the nice thing is when we do this discrete wavelet transform decomposition into the different frequencies, they're orthogonal, so we can actually regress at all the different frequencies and measure the responses to these economic factors at different frequencies. So which variables are responding to within 2 months, which variables are responding to within 3 to 5 years. OK. So I wanted to show you this because I told you I was going to show you that gold was leading. Then I showed you gold was leading with the spectrogram. Now if I show you the breaks, this is the nominal price of gold now. And you can see 2 breaks. One in 1979. It was gold that broke, not oil. So we don't find a big jump in oil prices in 79. It was actually a purely inflationary effect, and you saw it in the spectrum in the coherence diagram that gold was leading oil at the time. So you get two breaks in gold, one around 79 and one around 2009, right? The difference is in 79, everything was driven by gold because it was really the story of inflation. And here, it's really a story about gold, about oil, and you see multiple breaks. So first, you see a break up around 2003, 2004, then another break up around 2006, then, of course, a break down after the crash, then another break up. So that's why I would look for multiple breaks, not just a single break. And the correlations, because you see breaks even in the series itself, let alone its relationship to other series. You can see gold is showing only the two breaks here, one when it broke up, one when it broke down, and with oil you see a lot more action. Okay, so we'll take Saudi Arabia as the canonical country that may react to potentially falling prices. So what's the story again? We have sluggish growth, therefore demand is not going to grow much. We have surging supply, all because of the high prices that are held up by the Fed's inflationary policies, and other central banks are jumping. If you can print $1, I can print 100 yen. And so the only thing that will stop oil prices from falling is if production is cut somewhere else. Can Saudi Arabia cut its production? Well, if we go back in our historical series, and look, Saudi Arabia does a pretty good job now. Their immediate reaction, and the highest frequency I'm looking at here, 2 to 4 months, is only to gold. So they're reacting to the real prices. So you can think of gold as a measure of the real value of the dollar, right? And so it's reacting directly to the price of gold. But then as fast as 4 to 8 months, it's starting to react to oil prices. And then it reacts to the S&P 500. It's reacting to everything, just like hoteling would write an economic model. If you're thinking, should I take this stuff out to the ground and sell it? The question is, how much do you get for it? And what kind of a rate of return are you going to get on it when you invest it? Right? Saudi Arabia is really canonical. But most of that was really in the 1980s. And I don't have time to go into the details. But you can see the effect of the price persisting up to a year, and the price of gold persisting, beyond that. And even if you go up to 3 to 5 years, the price of oil is still giving you the right results. Okay, so Saudi Arabia reacted, of course, very, very strongly in 1982 to the demand destruction and the coming online of North Sea oil, Mexican oil, and other non-OPEC countries responding to the high prices in the 70s, right? All of OPEC agreed to cut its production. Everybody else cheated. Saudi Arabia actually overdid it by cutting its own production all the way down to about 2.2 million barrels a day in order to try to keep price within that sweet spot of 34 or something like that at the time, right? And so Saudi Arabia really cut its production here, but then, of course, we know what happened. Everybody else was cheating, and the Saudis felt that they were being taken advantage of, and so they just declared, we're done with that. They brought their production all the way up to 6 million barrels, and price just plummeted, right? So at least for a period of time, Saudi Arabia was willing to cut its production enough in order to keep prices from plummeting. So if we're looking 3 to 5 years from now, are we at that point where maybe the Saudis or somebody else can do this for a while? Eventually, they'll have to give up, right? So in the long run, that's not going to work. But in the short run, they might be able to sustain it for a while. But can they? Right? And I should say Kuwait, similarly, was one of the few countries that followed suit and cut its production significantly in that same period. Of course, this is a collapse because of the invasion of Kuwait by Iraq. This is its recovery after the liberation of Kuwait. Okay, so the question is, well, can Saudi Arabia and other major producers, so Saudi Arabia and its coterie, right, Kuwait and so on, can they cut production the way they did in 81, 82 in order to keep oil prices from falling precipitously now the way they did in 85? Well, we're arguing no. Estimates vary, but most people say that the Saudis need oil at about $75 a barrel in order to meet its real core budgetary requirements at the current level of sales. But then the reaction of King Abdullah to the Arab Spring was to spread the wealth around. So most people think 95 is more like what Saudi Arabia really needs in order to both meet its real budgetary requirements and continue to appease its public so they don't have an Arab Spring-like event. Regardless of the exact number, right, we're talking about oil prices possibly falling back into the 30s. There's no way they can withstand that and be able to continue to do business for a long period of time. Okay, so that will not happen. On the other hand, so what we're going to do is say, okay, so, but oil prices then are going to fall for sure. Because demand is sluggish, supply is surging, prices are going to fall. Unless there is some sort of geopolitical event that can keep prices up. And so what we're going to do is look through our sample. So we're looking at all 19 countries that at any point during that sample period from 65 to 2013 ever produced 1 million barrels a day or more. And many of them did witness regime changes and other geopolitical events of various types. Did that ever lead to a disruption in production that will be a large enough reduction in supply to counteract the new supplies from shale? Right? And so, okay, well, in the case of Iran, you have this big drop onto a lower. So the Iranian Hubbert curve would have been going like this, right? Would have been going up to 9 million barrels a day, sort of like Saudi Arabia. But then it gets cut, and they're on a lower Hubbert curve from then onwards. Was that cut in response to economics? We argue not. It coincides with the Iranian Revolution, and it predates when OPEC starts to act, when Saudi Arabia and everybody else acts. And we see enough evidence that whenever there's a war, and especially in the case of Iran and Iraq, I mean, there are documented cases of destroying each other's respective oil facilities. So that's clearly taking stuff offline that would have been online otherwise, let alone that investment, of course, falls, and then you get the conflict with the US and the sanctions and so on, so there's no way you're going to get back to that original Hubbert curve. Iraq, we have, so that's another reason. Iraq, we have the break around the same time when the Iran-Iraq war starts. It actually was having a big surge originally with Saddam Hussein, and then it immediately jumped right back down after the war with Iran started and some destruction. It tries to recover a little bit, but then there is the invasion of Kuwait, which brings it back down. Then it surges back up in '98 when many other countries were surging in response to price. So war definitely had its effect in substantially reducing the supply from Iraq and from Iran, and as we saw before, from Kuwait in 1990. But we have examples of regime changes that did not lead to disruptions. And the example here is Venezuela. So Venezuela, we have the big surge as a response to the original price stimulus in '73. But then it's on sort of a somewhat gradual, they invest more, and eventually that comes online. And they're sort of on a Hubbert curve. Maybe they could have eventually gone on an even higher one. And the election of Chavez in '98 prevented them from continuing on the higher one. But they certainly stayed on the one they were on. It wasn't a disruption. So it may mean that in the long run, they don't reach their full potential, but it doesn't mean in 3 to 5 years, production will decline substantially. Libya is a very interesting case, obviously, for many, many reasons, because there are just so many different disruptions. But the important thing is 81, again, it wasn't an economic response. It was actually literally firing a rocket at the US naval ship, and then the US putting sanctions on them and banning American companies from doing business in Libya and so on. So it was sort of like war. So what's the conclusion? The conclusion is that war can lead to substantial reduction in production, but regime change by itself wouldn't. So if prices fall, they can't respond to potential falling prices by cutting their production because they need every single dollar that's coming in. Then prices will fall. That may put pressure on the regime. You may, lose one ruler and get a more reformed ruler who, allows more inclusion for the youth and women and so on. But that's really not going to lead to a big disruption. What you worry about is wars. So the story is really simple. demand will continue somewhat similar to the 1980s to erode away because of the sluggish growth plus improved efficiency standards and movement to more service-based economies. Supply is going to grow, again, similar to the 1980s, high prices, you're going to invest in new technologies. In this case, it's going to be shale, which is perhaps as revolutionary as the North Sea offshore revolution was in the 1980s. And we don't expect that any type of voluntary reduction is possible in output in order to accommodate this, because then the Arab Spring turns to an Arab autumn for them. And so we add those three, prices should fall unless there's a war. So we can't tell you what we think will happen in the medium term, but we can tell you there are three scenarios. One of them, if there's no war, prices are going to fall, and they're going to fall hard. If there is a war, so Iran, the proxy wars between Iran and Saudi Arabia that are taking place in Syria and Bahrain, blow up into real war, where rockets are actually sent and they destroy facilities or close the Straits of Hormuz or something like that. Then price is going to go to unprecedented heights, 250 plus. So we have these two extremes, 35, 250 plus. The only way you can really stay where you are now is a continued inflation. This is an old, you can't have inflation without growth in the money supply. You can't have a bubble without increased credit. And of course, what we have is both of these with quantitative easing. So you're creating a bubble, but a bubble requires a story, right? So the story for the housing bubble is house prices always go up and so on. Eventually, the story dies out and the bubble has to move somewhere else. So quantitative easing by itself is not enough to keep prices where they are, because the story is going to run its course and the bubble will move on to something else, cornfields or something. It already is, right? So what you need is the bubble environment with inflationary monetary policy plus a story. And for as long as Syria is going like it is and Bahrain is going like it is, the story is ever present. So the only way we sustain this bubble, which unfortunately will keep us in this sluggish growth and unemployment rates at the levels and so on, is that you continue with more and more QE up to QE infinity, and the ever-present threat of war, but never real war. Okay, so go back to Daniel's. Would I buy? So I'll buy a straddle if I thought that this sort of knife edge is not likely. So I'm either going to go to 35 or 250. Then I'll buy calls and puts. Right? If I believe that those two extremes are impossible and we're going to just stay right where we are, then I'll buy a straddle. But I'll stop here. Thank you.
We have time for a couple of questions if there are any.
How much of a war premium do you think's in it? I mean, if you look at it, you look at crude right now. We opened the year at 93.16. We've traded in about a $12 range, holding that 84.5 to 98.5 level, and the market's really balanced. You went back to your one graph on the oil and the economy, and it was kind of on that.
Yes, that's one.
Turn. Yes, and so we're kind of right in the middle of it. And how much of you said it would take like 90. The Arabs want $95 because that helps them, pay for a lot of things and to keep everything going. It hurts us on one side and it hurts growth in a lot of other areas. So, I guess my question is how much of a war premium is in there, and also, is it being manipulated, do you think? I mean, quantitative easing aside, do you think that it's artificially being held up here for other reasons? Because every time it goes down to 84.5, the dip buyer is always there.
Yeah. Well, and one could get cynical and say, I think so. Amy and I have been on this story since 2005, and we even put something in our book, which was, I guess, published late 2009, officially 2010, that a little bit of terrorism was good for business if you're an oil exporter, and now it's a little bit of a war threat. These things are controllable, and there are questions about who is funding different militant groups that will prevent potential resolution so that the war premium will go away. And you're right, QE by itself will not keep it always in oil. It will go somewhere else. So copper has already dropped. Oil is dropping now. And copper has already dropped. Gold is dropping now, and oil will follow, if other things equal, simply because when you're hanging around just below your long-term mean, that's not enough for a recovery. It's just not enough to jumpstart the economies. And so, and there's demand erosion because of improved efficiency and service sector growth and so on. And there's surging supply. So, the war premium will keep getting bigger and bigger if we were to hang around here, right? How much exactly, is anybody's guess. But if we were to drop to, the kinds of levels we did in 1985 in order for a solid recovery, like the Clinton years, we think you should be down to the 30s.
So what I would say to you is imagine the image of that cartoon Wile E. Coyote. So I see like the price of oil is sort of like the guy spinning his feet and everybody believes that he's on ground. He believes he's on ground, and it seems like he's on ground. And the question is, if tomorrow there was a headline off the NYMEX that the UN has a negotiated peace treaty in Syria and they're putting UN peacekeepers in there, what do you really think would happen to the price of oil? I mean, I think you all have to step back from this analysis that's based on the cost of oil sands as the marginal barrel and think about psychologically what would actually happen in the market if you took this war thing off the table. And it might hold the price up for a really long time, hard to say, but when you look at it from this cycles way, you're really looking at the long-term trend. I mean, we're like over the hump of where we would be to fall down again.
So is the cost of production irrelevant?
No, the cost of production depends on how much you're selling. It's the marginal cost, right? So if price falls down to 35, my guess is a lot of the things that companies may be investing in that is such high cost will go offline.
Right, which will bring the price back up. So you're talking about a short-term excursion?
Medium. So that's why we're doing everything. We have to define what frequency. That's why I showed you this graph. Different things happen at different frequency. That's why we focus on that 3 to 5 year frequency, which is long enough for investments that are ongoing to continue and to affect supply, but not so long that prices would have responded again. So, I mean, the cycle, so we trace it back to the book Amy and I wrote. We trace it back and we say this is an endogenous and self-perpetuating cycle. And what happened here is that around 2003, 2004, there was a story of the great moderation. The business cycle is dead. And there was financial appetite for anything moving. And then you had a geopolitical event that restarted the whole thing again, just like we started in 73. And so we're going through at least one more phase of this whole thing. So yes, prices will fall and then they will rise again.
So, and let me just mention to you all, because everybody has a very short memory, I remember my first year here at the Baker Institute, 1996, I had to sit down and interview companies that were doing oil sands, and the clearing price for oil sands was $12 a barrel. And it's the same physical stuff. And when you say there's a labor shortage, there's this, there's that, what does that really mean? I mean, people are out of work, and it takes a certain amount of time to train people. So, in the end, as Ken showed in his chart, the cost, if the industry has to make money in shale at $40 instead of $80, somebody's going to come into your management and say, I need you to do this for less. Before you shut in, the first question will be, can we do this for less before you shut in?
And with technical progress, eventually every barrel will become cheaper.
Every barrel gets, it's going to get shut in and you go back to the cycle. But the first question that people ask in the North Sea is not, we're going below $34, let's shut in. That was Yamani's mistake. He thought everybody would shut in. And everybody went to their operating costs, which he turned out mistakenly thought was above $15, and it turned out it was $3. Right? So, there's a lot of ear there. That's what I'm saying. There's a lot of ear there. And I'm not saying that, it's tomorrow or a month from now or whatever, but it's like you can't cheat gravity. It's a cyclical industry, and, I think what this research shows is we're on the other side of the curve, barring a geopolitical event.
So does that put the U.S. at more risk? Because we have more cost in production. for shale. Shale is there's a bottom line for shale cost, but it could be adjusted like you're saying. But we have to incorporate rail costs too. So wouldn't that make us more at risk then? Because we have double risk here.
Well, I mean, there's this fixed cost and variable cost, right? So when prices fall, it will be cheaper, and the economy is sluggish, it will be cheaper again to import oil, and all this nonsense about independence from foreign oil and so on will stop, because why should you burn the expensive stuff when the cheap stuff can come in tankers or pipelines? So I don't know what you mean by hurt the U.S. In the long run. And that's why we thought peak oil was silly. I mean, as Ahmed Zaki Yamani said, the oil age is not going to end because we run out of oil, just like the Stone Age didn't end because we ran out of stones. So eventually, when you're thinking long run, yes, investing in a lot of technology that you may never use, if this plays out in such a long run that you stop burning so much of that stuff because other sources of energy are coming online, environmental standards are getting stricter, and so on, it would be folly to overinvest right now.
I have an answer to that that's very specific. And 5 years from now, you're all going to say I'm wrong, but we'll see what you think in 5 years. If you're an oil company and you have a choice to deploy assets on shale, which you can produce in 1 to 2 years, or you're going to deploy the same capital on an Arctic project that'll take you 20 years to get off the ground, why are you investing in the 20-year project? I mean, I just think you have to ask yourself that question. If you believe at all that the environmental standards are going to tighten over time, then the time horizon for your investment should matter, and therefore shale should take a priority at the beginning right away, because you can produce it and get it out of the ground now before the price falls. And you have so much uncertainty for what the market is going to be for that product in 20 years. It's not clear to me why people are doing pre-salt Brazil or Russian Arctic or something like that. It doesn't make sense to me, but maybe there's something I don't see because I don't do FDI every day. But from the outside, looking in, it doesn't seem to make sense to me, per your question. That would be my answer to your question.
I'll add one thing. It's not an on-off, like sudden start, sudden stop kind of thing, because, I mean, if you start to see prices soften enough that it puts, the marginal barrel in the Bakken shale sort of upside down, right? Well, you're going to start laying down rigs as you start taking that marginal acreage off, right? Well, that basically means you end up with surplus capacity in the rig inventory. What happens to rig rates when that happens? They start to fall, right? So it means that marginal cost, that marginal barrel becomes cheaper over time.
Including rail and storage.
Yeah, absolutely. That's why price and cost move together, in a nutshell.
I guess we'll leave on this cheerful note.
Very good. Thank you. No, I don't know. You don't mind, yeah. Okay. Let's go ahead and take 15 minutes for a coffee break and reconvene for the last panel of the day, which should be very interesting. I have to admit, so.